Picture this. It's late at night, and you're scrolling through social media. A flashy video pops up. Some 20-something-year-old on a yacht, sipping champagne, claiming they cracked the code with a secret stock that doubled their money overnight. Or maybe it's closer to home. You're at lunch with a co-worker, and between bites of their sandwich, they whisper about a can't-miss company that's about to explode. You nod, your heart racing. You feel that itch, the fear of missing out. You think, if I don't buy this now, I might miss my one shot to finally get rich. So you take the leap, you buy in. And then what happens? The stock drops. Fast. That rush of excitement, gone. Replaced by regret, frustration, maybe even shame. You start wondering, is the stock market rigged? Am I just unlucky? Or maybe investing isn't for people like me. Here's the twist. Even if you had the worst luck in the world, even if you invested right before history's biggest crashes, you'd still be wealthier today if you simply stayed invested. So why do 90% of people lose money in stocks? And more importantly, how do you become part of the 10% who actually win? Before we dive in, I want to hear from you. What's the strangest investing advice you've ever heard? A viral Instagram reel, a cousin at a barbecue, or maybe a random stranger in an Uber who swore they had the inside scoop? Drop it in the comments. You're not alone. Winning in the stock market comes down to having a strategy. Without one, it's not investing, it's gambling. It's like walking into a Vegas casino, throwing chips on a table, and hoping for luck. Sure, the lights are brighter, the numbers look official, and you call it investing, but at the end of the day, it's just chance. And that's why most people lose. They go in without a plan. They let emotions, headlines, and hype dictate their decisions. Here's the truth. Every investor eventually falls into one of three paths. The sooner you know which fits you, the faster you can start building real wealth. Path 1. The passive investor, the set it and forget it crowd. They invest in broad funds like the S&P 500, stay consistent, and let time do the heavy lifting. Path 2. The advisor-guided investor. These investors want guidance. They hire someone to manage their portfolio and make decisions. It costs more, but the peace of mind can be worth it. Path 3. The active investor, hands-on and engaged. They study markets, dive into reports, and aim to beat the market themselves. More time, more risk, potentially more reward. Think of it like food. Some meal prep the same healthy dishes every week. Consistent and effective. That's the passive investor. Some hire a nutritionist and chef. They want results without thinking about every detail. That's the advisor path. Some experiment with recipes, counting every macro. That's the active investor. None of these approaches are wrong. What matters is knowing yourself, your patience, and your goals, and choosing the path you can stick with. Now let's take a deeper dive into the three paths to see which one fits you best. Path 1. The passive investor. Imagine this. You're not glued to your phone every day, stressing about whether one stock goes up or down. You're not chasing the latest rumor or hot tip. Instead, you're playing a completely different game. One where you're betting on something much bigger. Not just one company, but the entire economy. That's the mindset of the passive investor. And here's the crazy part. It works. Over the last 100 years, the stock market has seen it all. 2 world wars, the Great Depression, runaway inflation, the dot-com crash, the housing collapse, even a global pandemic. Every single time people thought, this is it, this is the end. But every single time, the US stock market bounced back, averaging about 10% annual growth over the long run. So why does this strategy work so well? 3 big reasons. First, diversification. If you buy something like the S&P 500, you're not betting on one company. You're buying a slice of 500 of the biggest, most successful companies in America. Apple, Microsoft, Starbucks, Costco, they're all in there. Second, automatic upgrades. If one company stumbles and fails, it just gets swapped out for a stronger one. You don't have to research, panic, or make changes. The index adjusts for you. And third, Consistency wins. Your only job is simple. Keep buying. Whether the market is up, down, or sideways, you keep adding. That's the secret behind what I call ABB. Always be buying. Now let me give you a few ways to picture this. Think about your Netflix subscription. Some months you watch every night. Other months, hardly at all. But you don't cancel, right? Because you know over time it's worth it. Passive investing works the same way. You keep paying in no matter what today's episode looks like. Or think of it like planting a tree. At first you barely notice a difference, but year after year, it grows taller, stronger, and eventually gives you shade and fruit. That's your portfolio. Slow and steady growth that suddenly feels massive when you look back. And here's one more. Owning the S&P 500 is like owning a giant shopping mall with the 500 best stores in the country. If one store goes out of business, no problem. It gets replaced by a thriving one. Meanwhile, you just collect the rent as the mall becomes more valuable over time. Now let's put some numbers to it. Say you invested $1,000 a month, about what many people spend on eating out or random subscriptions every single month for 30 years. Even if you had the worst timing possible, buying right before every big crash, and you never sold, you'd still end up with close to $2 million. That's the power of consistency. So here's the real question. Would you rather have the slow, steady growth of a tree, something that lasts for decades, or the quick flash of fireworks, bright for a moment but gone in seconds? Drop it in the comments. Are you a tree person or a fireworks person? Path 2. The advisor path. Maybe you're not the DIY type. You don't want to spend weekends digging through earnings reports, comparing funds, or stressing about whether you picked the right investment, and that's okay. Not everyone wants to be their own money manager. That's where financial advisors come in. Here's how it usually works. They take your money, invest it for you, and ideally, grow it over time. Some advisors might even beat the market, at least for a while. But here's the catch. They charge fees, and those fees often look tiny, usually around 1% a year. Sounds harmless, right? But over decades, that 1% can quietly snowball into hundreds of thousands of dollars that could have been in your account instead of theirs. Let me give you a way to picture it. Hiring a financial advisor is like hiring a personal trainer. Can you get fit on your own? Absolutely. Plenty of people do. But some people like the accountability, the structure, and the expert guidance, and that's worth paying for. The only thing is, not every trainer is a pro. Some just stand there, count your reps, and cheer you on. Same with advisors. Some bring real expertise, while others are basically charging you for stuff you could have done yourself. And that's why, if you go this route, you've got to ask the right questions. Like, how do you get paid? Is it a commission every time they sell you something, or a flat fee for managing your money? What's your plan when the market crashes? Because markets will crash, and you need to know if they'll keep you calm or just panic right alongside you. Are you investing based on my goals or yours? Believe it or not, some advisors build portfolios that benefit them more than you. Here is a quick story. I once met someone who felt confident because their advisor had it all handled. They assumed this person was using some secret sauce, some hidden strategy to make them rich. But after digging into it, guess what? The advisor was literally just putting all their money into the exact same index fund they could have bought themselves, except charging thousands in fees every single year for the service. Now, I'm not saying all advisors are bad. Some are amazing. They keep you accountable. They help with tax planning, estate planning, big picture strategy, all the things most people never think about. But the key is knowing what you're paying for and making sure it's worth it. So let me throw it back to you. Be honest. Would you rather pay a little extra for peace of mind, or would you rather do it yourself and keep that money in your pocket? Drop it in the comments. Type peace if you'd hire an advisor, or DIY if you'd rather take control yourself. Path 3. The active investor. This investor isn't satisfied with average. They don't just want to ride the market. They want to beat it. Now, done right, This doesn't mean chasing hype stocks you saw on Reddit or taking tips from your cousin's WhatsApp group. That's not investing, that's gambling. Real active investing is about studying the market, spotting trends early, and making moves before the headlines ever catch up. Let me put this into perspective with a little thought experiment. Say you invest $1,000 a month for 30 years, and you just match the market at around 10% annual growth. By the end, you'd have about $1.9 million. Not bad, right? But here's where it gets interesting. If you manage to beat the market by just 3% a year, we're talking 13% instead of 10%, you could end with over $3.5 million. That's an extra $1.6 million just from being a little better than average. That's the appeal of active investing. The upside is massive, but here's the warning, the risks are massive too. If you treat investing like a slot machine, chasing quick hits, you'll lose. If you panic every time your stock dips, you'll sell too early. And if you're buying just because your favorite influencer told you to, that's not investing, that's blind gambling. So here's a better way to think about it. Owning stocks is a lot like owning rental property. If you buy a house, you don't check Zillow every single hour to see if the price went up or down. You're thinking about the location, the rent it brings in, and the long-term value. It's the same with stocks. If you believe in the company, in its growth, its products, its future, then you hold on to it. You give it time to mature. Active investing can be rewarding, but it's not for everyone. It takes discipline, research, and the ability to stomach volatility without losing your cool. So let me ask you, do you see yourself as more of a long-term collector of wealth, someone who just builds slowly and steadily, or a hunter of opportunities, someone who's out there actively trying to get ahead of the curve? Drop it in the comments. I want to know which camp you're in. When it comes to investing, the edge isn't in chasing the latest hot tip, it's in truly knowing yourself. Whether you're a passive investor, letting the market do the heavy lifting, guided by an advisor, or actively hunting opportunities, the real winning formula is following a plan you can actually stick to. Because let's be honest, investing was never about one lucky stock pick or the next viral video. It's about building ownership, piece by piece. It's about investing in progress, holding your ground, and letting time do what it always does. Reward patience. That's the real secret. The market doesn't care about hype or your emotions. What it rewards, every single time, is discipline, consistency, and a long-term mindset. So the real question is, which type of investor will you become? The steady tree, growing stronger year after year, the advisor-backed client, paying for peace of mind, or the opportunistic hunter, chasing the upside? Whatever path you choose, make it intentional and stick with it. Building lasting wealth starts here. Join the wealthy edge and take charge of your financial future.